Good morning, ladies and gentlemen. Thank you for joining us. MoneyShow is delighted to welcome Ina Rosputnia, author of Basic Instinct of Trader. Ms. Rosputnia is a stock and futures trader and also the CEO of ManagedAccountsIR.com, a finance expert and analyst who writes for Benzinga, Equities.com, The Businesswoman Media, and Investing.com. Ina, thank you so much for joining us. The floor is yours.
Thank you, Jessica, and thank you everyone for coming to see my presentation. And today I want to break down how you can actually build wealth in turbulent market conditions, because most of investors are afraid of those conditions, but in fact, they represent a great money-making opportunities for skilled traders and investors. Warren Buffett once said, "Be fearful when others are greedy and greedy only when others are fearful." And it's a very wise words, but it may sound a bit difficult. How you can know when you should be greedy and when you should be fearful? In fact, there's a lot of tools that can help us to understand when the major global and long-term cycles are about to turn to the downside or to the upside. So we can use that. We will never be perfect with the timing, but still we will be very close. I believe that right diversification is the key, and most of the investors simply ignore this fact. They want to stick to the most popular markets in most cases, and this is it. So we have few types of diversification, and the most undervalued type of diversification is asset classes. That means that you invest in a different asset classes, and only small part of investors really do that. But when it comes to turbulent times, most of the investors suffer a lot and lose their wealth, while those few who follow this rule and diversify their portfolio with a wide range of asset classes stay in the game and make money during the turbulent time that in fact bring the best results and the most significant profits. So when it comes to significant warnings from economy that we are about to turn to the downside, first, what investors should do is to think about diversification into different asset classes. And I'm talking about not just a classic instruments like gold, bonds, and so on. There are a lot of other instruments that we can focus more easily because they are more supply and demand driven and less speculative. So, for example, it's agriculture sector. The most supply and demand driven sector is agriculture. So you can consider buying or selling futures on agriculture products. Of course, you should do a deep research before considering any kind of diversification on your portfolio. And another extremely important thing when it comes to turbulent times is liquidity. Liquidity is how easily you can turn your assets into money. And liquidity in the times when markets are booming and liquidity in the tough times are two different things, because it can be very easy to sell your property, for example, when everyone wants to buy, economy is very strong and you can easily find a buyer. But what happens if economy turns to the downside and you didn't notice it on the time, for example, and missed the opportunity to sell your property? In that case, the liquidity of your assets is very, very low, and it's really difficult to turn your asset into money. So you have always think about liquidity, what will happen in the case if. It's like the worst case scenario, but when something happens, you will be ready for that and you will meet that opportunity, cash out and switch to other market that offers a nice money-making opportunity. Because liquidity is number one for investors. It's what really helps you to be flexible and easily switch between markets, sectors, and so on. You have to invest your money in the sectors where is the max possible opportunities with the less possible risk. May sound like a mystery and fairy tale, but we can compare the risk, we can compare the potential gains in the markets, and this way we can switch between the sectors and the market. So as I mentioned a few minutes ago, real estate is a real estate under the risk now. It's the most popular investment tool because people believe it's really easy to own real estate and make money on it. But sometimes we forget about carrying cost. There is no carrying cost for stocks, for example, or for futures, but in real estate, we do have it. And if economy turns to the downside, for example, and our financial situation changes, liquidity is very low, so it can cause a lot of problems for investors because if they had bad financial plan, they are just not able to support their current circumstances and their real estate anymore. So always keep that in mind. And this chart represents a national home price index. And as you can see, we saw a significant move to the upside, but in most cases, what rises very sharply will end the opposite way. So we will see sooner or later significant decline in this market, which is quite normal. It's absolutely normal for any market to have a pullbacks at times of consolidation and so on. But if we are active investors, we want to get the most from one market and to switch to the other market. So we have to be aware of risks coming into any specific sector and switch to other sector. So we saw significant rise recent few years in real estate in America. And the next chart is 30-year fixed rate mortgage average in United States. And we certainly see that the trend is to the downside. But I have highlighted a few zones of consolidations and similar patterns. And each of those zones ended with the rise. You can see the first one here, we consolidated, we saw the rise. Another consolidation that took a bit longer, but anyway, we saw the rise of interest rates. And here again, consolidation, building the base and the rise. Again, building the base and the rise. And this current pattern, in fact, is very similar to what we have already seen multiple times. So it's very possible that in coming years, there's no immediate effect, by the way, of this chart. So in coming years, we can expect that interest rates will rise, and that will influence the market, the real estate market, very significantly, because the people will have less desire to borrow money and buy real estate. As a result, we will see less buyers in the market and prices can go down. Another very interesting chart shows us the number of homes available for sale. And you can see that recent 2 years, we saw a dramatic decline of the number of houses available for sales. In other words, the investors are not willing to sell their properties right now. And the current rise of the prices in real estate is caused by that, first of all. It's not that we have more buyers willing to buy. We just saw significant decline of sellers. So here's the question: what will happen if we see economy turning to the downside? That number of sellers will increase sharply, and that will cause a big offer in the market. As a result, we can see a significant and sharp decline of real estate prices. I'm not saying it's going to happen this year or something, but that's the risk when it comes to real estate. And this risk, we can see the results of this risk in the coming few years. So keep that in mind when it comes to buying the real estate in years' time. So let's have a deeper look into economy and stock markets. Are there any risks for economy, as I mentioned before, and for the stock market in particular, or are we still safe and we can continue to buy the dips and enjoy the rally? This chart represents an inflation, and you can see the green lines, which is recessions. So each time the inflation was above 5%, we entered into recession, almost each time, right? And currently we are above 5%. which doesn't mean that we have to sell all our stocks right now. It's only one of the factors that potentially has entered into a risky zone, which is no immediate reversal or something like that, just to be aware of this. Another important economic data is unemployment rate, which I believe is extremely important for the stock market. Again, the green lines you see is recession. And when we see unemployment rate entering the, let's say, bull market or entering the rise, or we see the beginning of recession, but still, as you can see, we are far from any higher readings and any positive dynamic in unemployment rate. So by this factor, we can consider that we are still safe with our stock portfolio and with the economy overall. Temporary help services, another important factor each investor has to be aware of and monitor. You see that each time the temporary help services rolled over to the downside, we entered into recession. Another example here, turn to the downside, recession, turn to the downside, recession. Here's where we're now. We are far from any negative readings, at least as for now. This situation can change, but we can easily monitor it because this information is available for free. And this chart is very important for skeptical investors. And you can see the red lines is S&P 500 chart, and the blue line is temporary help services. So when we saw decline in temporary help services, we saw this significant decline in stock market. When the temporary help services turned positive, we saw the rally in the stock market. It doesn't mean it's the only indicator you have to trust and you have always follow the temporary help services, but it's always about combination of few factors, a few economic factors, few economic indicators that when they all come together, they generate significant signal for us to be aware of coming risks or about coming buying opportunities in the stock market. And to be honest, in the real estate market as well. Another chart of temporary help services. I want to pay attention that when we saw readings below zero, we saw decline in stock market and in real estate market. And once again, we are far from readings below zero, at least as for now. Another very important factor is the real median household income in the United States. It may sound like it doesn't have any relationship to the stock market and it matters only for real estate, but in fact, there's a very strong interaction between income, between real estate and between stock market, because when people have money, they spend a lot, they boost economy, they boost business, and as a result, we see strong real estate market and strong stock market. So let's have a look. When we saw that household income dips, we entered into recession. Here's one example. Here's another example. A dip in household income, recession. Again, dip in household income, recession. It seems like we rolled over a bit here, but it's not enough time for us to say that this indicator is giving a sell signal, because here it took much longer time to see a negative dynamic of household income. And when this dynamic was stable and it happened during a long period of time, we entered into recession. So it's not a risk yet, but it's something we want to watch, because if in the coming few months we will see more moves to the downside in this indicator, that will be another warning signal for us that we may see significant decline in the stock market. But overall, as you see, the most of economic indicators are still quite positively stable and still support the rally in the stock market. Another important factor is business conditions, and it matters a lot. If a business has a good conditions for development, for profits, we see a strong stock market and strong real estate market. So where are we now? As you can see, we are very positive and very strong with the business conditions. So there is no risk from business conditions for the stock market or real estate market yet. And another important indicator is leading index for the United States, which is quite positive, at least as for now as well. And you can see that to see any kind of risks from a leading index, we have to see it moving down for quite significant time. And especially when it enters reading below zero, we see recession multiple times here, again here, and again in 2008. But as for now, we are very strong and positive with these readings and with leading index. So if not now, then when? When can we expect that stock market will be under the risk and we have to diversify our portfolio with other asset classes? The timing is the most difficult thing in trading and in investing, but we have a lot of timing tools that help us to understand the risky period, I would say so. So based on the timing tools and all the studies of economic cycles, natural stock market cycles, and intermarket relationship cycles, all of them suggest that in the coming 2 years or so, we can see a massive rotations in all the financial markets, including stock market. But it's not right now, and it doesn't mean that in 2 years you have to get out with from the stock market and move to some other kind of market. But it just says if during this risky period of downturn, we will see mentioned previously indicators giving us the warning signal that the economy is doing not so good and we can expect significant weakness in the stock market, then it makes perfect sense to review your portfolio, to hedge it, or to move into other classes, asset classes. But as for me, it always makes sense to diversify, and especially nowadays, because everything changes so fast and we have to monitor it and react very quickly and adopt to new conditions very quickly, because otherwise we will miss a lot of great opportunities on other markets, and that's in the best case. In the worst case, we will suffer from significant losses if we don't accept the new reality, if we don't accept the changes of conditions. So we have to be very flexible as a traders or investors. Time is the wealth through which money comes, and that is so true. The most difficult thing in trading and investing is timing, but it's one of the most important things in investing. And I have to say that we'll never get the absolute top and the bottom in the market. We will never be perfect with the timing, but we can be very close to those tops and bottoms. We can be very close to those perfect timing. And in fact, we don't have to be perfect. We just need to get the major moves, the major change of the global trends, and to get the most significant part of this new trend, because this will give you money, and then feel flexible to look for another opportunity with another assets and switch between the sectors. This is it. Thank you for watching, and we have some time to answer questions if you have any.
Thank you, Ina. That was a great presentation. We don't have any questions just yet, but there is a little bit of a delay with the attendees, so they have time to type in some questions. In the meantime, on your screen, it looks like you have put your contact information, so that would be how they'd be able to get a hold of you.
Yes, and they can also visit my blog, where they can find a lot of free research on the real estate, stock market, and other assets.
Perfect. So again, ladies and gentlemen, if you have questions, please feel free to type them right there in the chat for Ina, and we will be happy to get them answered. So sorry, we should have been more proactive in asking for those questions. But no, that was a fantastic presentation. Absolutely. I love when I
Thank
can
you.
moderate interesting, educated people.
You know, it's always the most important part is to adapt to new conditions and to combine fundamental analysis with technicals, because I don't believe that one type of analysis is better than the other, but the combination of all of them is a really powerful tool. When one tool confirms other, when one type of analysis confirms other, we give less trades, less invest in ideas, but they are more profitable, and that's what matters the most, what you get in result, right?
Richard asks, what is your opinion about multi-asset funds, which tend to have about 30 to 50% in equities and the remainder in bonds or bond-like funds?
Well, I like other approach, and personally, I don't invest in those types of funds. I like to create my portfolio on my own, because I don't know how deep is their research and so on. I like to specify my risk in particular asset and on all my portfolio, and then move from that point. And when you specify your risk, you can find frankly very good buying opportunities in the market. So I believe that it's not the best investment options, those funds, because there's a lot of ways to get more significant gains with the same type of risk.
Great. B asks, if you had spare cash to invest right now, what sector would you invest in?
Well, right now I have few positions running, and if you are following some of my webinars online, you know that a few weeks ago I made a call to buy Australian dollar, which is still for some time a good asset to own, but I believe not for a very long time. Nowadays, it's very difficult to make a long-term forecast that will last for a year or a few years. So the best buying and selling opportunity what you can find usually lasts for a few weeks or so. So that's why I believe that active searching for these few weeks trades is the most effective use of your spare cash at the moment. So just be flexible and look for that kind of opportunities.
Great. Holger asks, would you rather buy, hold, or sell real estate right now?
Right now, I would stay on the sidelines, because I believe that in the coming years, there is a big chance we will see significant decline. And after that, I will consider buying real estate. So right now, I am not buying real estate. I believe that risk reward right now is far from good. And that's why I like to focus on futures and commodities, because to be honest, at the moment, commodities offer the best risk reward ratio.
Matt asks, how do you determine which precedes which? Which of the indicators are leading versus coincident?
You mean economic indicators I mentioned in this presentation? I like the combination of indicators. So at the moment, most of economic indicators are still bullish. So we still have some time for economy and for the stock market to rally. But when most of those indicators will turn bearish, in that case, I will be very cautious about the stock market, and potentially I will be even looking for some sell opportunities in the market.
And Linda asks, how do you see the current and projected government deficit affecting the market in the short and long terms?
Well, as I said, it's all about combination of the factor. I don't think that deficit is the most important or the only factor we have to pay attention to. It's about the combination of the tools. And as for now, we are safe for some time, right? But in the coming 2 years, the situation can change absolutely.
All right. Howard asks, do you see M2 money supply as a market indicator?
In fact, a little bit, but not as the most important one. I just like to analyze the money flow in general, which sectors are leading and how much money do the people have, because I believe that consumer spendings, in fact, is the more important indicator. Because what I realized based on the studies of data and charts, that it has more close relationship with the stock market.
All right. And Walter asks, which is your preferred indicator for entries?
Well, I use indicators to find the markets that are ready for significant move to the downside or to the upside. So those are more fundamental indicators, if I can say so. But when it comes to entries, I use classic technical analysis without indicators. I may use a pinch punch strategy. That's the ADX readings above 60 and turn into the downside, and at the same time oscillator readings below 20. In that case, we have so-called punch, and it generates a buy signal. But anyway, I don't enter just because of this punch. I'm looking at price action, break above the trend line, and so on.
And Ron asks, what about the inflation now and in the next 1 to 2 years?
The inflation is really a risky factor at the moment for real estate and for the stock market. But as I said, only inflation is not enough to turn the stock market to the downside. Yes, we can see some short-term sell-offs, but it's not able, as for now, to turn the global trend to the downside. But if we will have high inflation plus other negative economic indicators, in that case, yes, we can see a downturn.
All right. Les asks, do you use an algorithm to assess the various economic indicators, i.e. 50% drop in one indicator plus 30% change in another indicator equals sell 30% equities?
No, in fact, when it comes to economic indicators, I like to watch the dynamic of the indicator. Is the dynamic positive or negative? Because there is no immediate effect from the economic indicators on the stock market. So you need some time to watch and to see the dynamic. And once you have that, you can choose multiple sectors and analyze each sector separately, because each sector and each asset is unique. And for example, what matters a lot for stock market doesn't have any relationship to the sugar. So your task as an investor to find the weakest market to short and the strongest market to go long. So yes, you have to do a lot of research, of fundamental studies, a lot of technical analysis, but it pays off very well.
Wonderful. So that is all the questions, and we are finishing right on time. So that was fantastic. And as I said, we really appreciate you being here today, and it was a great presentation.
Thank you, Jessica, for hosting me, and thank you all for coming. It's always a pleasure to be on MoneyShow.
Thank you, Ina. You have a wonderful day. And yes, ladies and gentlemen, thank you for joining us, and be sure to stick around for additional presentations on day 3 of the virtual expo. And I hope everyone has a great day.
You too.
Thank you, Ina. Bye.